We're looking at property on this show, and joining me in the studio is Stephen Barker, who's the head of home loans at Standard Bank, and also in our Cape Town bureau, Laurie Wener, who's the MD of the Western Cape region for Pam Golding Properties. Laurie, I want to start with you. Just give us a look at it from your perspective, and then we'll look at the banker's perspective. Where's property at the moment? Where do you reckon it's going? Are you bullish on it? Yeah,
we're always bullish on property. The long-term view on property is always good. It's when people expect short-term returns and short-term growth that they get themselves into trouble.
When you say long-term, what are you looking at there?
Long-term, we really look at more than 5 years.
Okay. And the Western Cape market, is that still as strong as it's been for quite a while? Because it didn't seem to falter, did it?
The Cape is fairly recession resistant. Mm-hmm. It's an old, proven market. People seldom move out, they mostly move in. However, we have felt the effects of the recession. Having said that, we are seeing a return of investor buyers looking at long-term investment, a return of foreign buyers, not in huge numbers, buying in the middle to lower market of the Western Cape, which is probably from about 2.5 million to 5 million. So it's tough out there, but interest rates remain low. There is a greater demand from mortgage-dependent buyers, which we need in the market, and all in all, it is looking better.
Stephen, from a banking perspective, there's constant moaning in the marketplace about banks not freeing up money and loaning it. Is that the case, or are you just being very, very conservative about who you are loaning to for obvious reasons?
So I think the way we could look at it is, from an industry perspective, we think we are about, for probably this year, going to be about a third of where we were at 2007. So if we granted mortgages, the total volume of mortgages granted in 2007, we only expect to do about a third of that. Okay. So there are multiple components. Have the bank's appetite, and the credit appetite tightened? I think part of the answer is yes. The consumer confidence is obviously also, a bit lower. So what we've seen, from ourselves is we've tried to, and if anything, we've been gaining market share at the moment, because we've tried to be as consistent as possible through the particular cycle. But is it tougher to get a mortgage today than it was, a few years ago? Yes, I think that is the straightforward answer. But people with good credit records have, maintained and also got a bit of money for deposit. I don't think that they're going to find that the world has changed much.
What sort of deposits are you guys looking at these days?
So generally, when we're dealing in the higher value properties, you're looking for, the general deposits above 2.5 million within the industry. You're probably looking at about 20-odd%. But as you come down off that, we will do 100% mortgage up to 1.5. We'd even help with some sort of above 100 for costs in certain select customer bases, up to R1 million. So it's not that you can't do, it's just that there's less of those bonds available.
Laurie, from your experience in the last few years, are there more mortgage buyers coming into the market, or are there still, are there still a fair amount of cash buyers coming in? And I'm looking here particularly at your international buyers who are coming in with the rand sitting where it is now against the euro and the dollar and the pound, which makes it a lot more attractive for them to buy.
Yeah, look, international buyers were almost non-existent from 2007. They are coming back slowly into the market, but they are not constituting a major sector of the market at the moment. We are finding that mortgage-dependent buyers, family home buyers, are coming back into the market where they shied away in the last few years to a large extent. They seem to be encouraged. They need to buy property. Interest rates are remaining low, and our percentage, in our company specifically, the percentage of cash buyers over the years has been extremely high, almost too high to be sustained at that level. We are very pleased to say that there are more mortgage-dependent buyers, and the percentage of cash buyers to mortgage-dependent buyers is far more balanced now.
Why would you be concerned about a very high incidence of cash buyers?
Because we need all the buyers to sustain the market and to sustain our business. You know, if you look at the market as a whole, what percentage of that market can really afford to buy for cash? At the top end of the market, true, they mostly can and do. But, you know, we need all price bands, we need all sectors of the market to sustain the property market and the economy. And therefore, we need people who are prepared to put their money down, their deposit down, buy a property, perhaps upgrade the property, move bigger, move smaller. We need people to move around to sustain this market. And they need to have the confidence and the financial ability to have a mortgage. It is part of the property business economy.
Stephen, where have you seen the growth coming through in the last few years? Is it in that lower end of the market?
So I think it's the way to go and look at it. We firstly got to cast our minds back, because I think everybody thinks of the market, particularly we all still look back on probably the sort of early 2000s up to this 2006, where we saw probably the best performance in our property market. And so with that attracted a lot of the investor type buyers, and maybe, you know, sort of a lot deeper than it traditionally did. Whereas what you're seeing today, and I think I'd support the comment, is you're finding a lot more buyers following the classical cycle type approach. So, you know, looking for that first home, then having to deal with a growing family needing more space, then ultimately, you know, getting to the particular point that there's a downsizing. So those people, regardless of the overall performance, you would find those, but where you've definitely seen a big change is people are not moving properties as quicker, or as quickly, and also there's substantially less investment activity within the market.
The issue that Laurie brought up there about people need, from a sustainability point of view, for the property industry, that people need to move. I remember when I was still on radio, I created a character called, she was a Santon Kugel property sales lady by the name of Bella Bupkowitz. Okay. And she had her company was Bupkowitz Properties. And the slogan was BP, we like to keep you moving. Mm-hmm. Because that is what essentially keeps the property business going.
Absolutely.
Laurie, where are you guys looking for new growth here? Because I want to get into the first-time homeowner and what they should be looking for. But where are you looking for new growth, and how are you trying to move that market?
Well, I think that there is huge growth on the Western Seaboard, huge potential for growth. There are a lot of properties on the market right up to and beyond Langebaan, which used to be a predominantly leisure holiday home market. Now the infrastructure of schools, retail, shopping centres, medical centres has grown exponentially over the years, and there's some very good buys on that coastline and lots of space and beautiful scenery. So I think there will be growth up that way. The northern suburbs likewise has plenty of flat land, easy to build on, wonderful shopping centres, good schools. So there's plenty growth in the West, plenty space for growth in the Western Cape.
But we
can't all live in Clifton and Bantry Bay. We need apartments, we need high density living. There has been a move, a very limited move, but we're seeing an improvement in the sale of newly completed developments at the moment, where people are not prepared really to buy off plan with all the inherent risks as they were when we were in a very speculative market, but they still are prepared to pay some sort of premium for something that is new, modern, and attractive. And we're seeing certain developments coming to fruition, and whereas they couldn't sell off plan, people are coming and buying them when they are ready and complete, and they can move in, which is something that we haven't seen for a number of years.
Now, I was just a few days ago speaking to a property agent in Johannesburg who's doing a development in the Morningside area of Johannesburg. And they, granted it's only 44 units, but they sold that out in 1 month, off plan. So there must be an appetite out there for people who are wanting to get into the market, maybe not necessarily for themselves right now. This may be a second house as an investment to sell when transfer comes through. Are you seeing any of those sort of trends coming through? Where's your growth coming?
Yeah, so I think the key thing with it is if it's the high value stuff, it might be the exception. I think the way to look at it is any good presented product, whether it be a house that's well maintained, a good quality development, will have demand. So I think, you know, those things would happen even in sort of some of the worst times. Where we're particularly seeing the growth and where there's a lot of focused energy is at the, you know, more to the bottom end of things. So particularly from the banks, we have been trying to sort of play a bigger role, trying to figure out if there's any, you know, where's the innovation in that space. So if you looked at a property development, if you looked at the number of activities and developments that are standing still in the multi-million rand category, specifically maybe we're more Gauteng type focused, versus if you go and look at the same thing where people are offering units in the 400 to sort of 700, 800, those are still going up, they're selling, you know, quite quickly, and those are providing people, you know, people entering into the market, you know, big opportunity. So there is that, you know, opportunity. We are seeing a lot more activity, you know, probably under the 1.5 million sort of range versus the stuff that sits beyond that.
Laurie, let's come back to you now.
Yes.
We're going to be going to a break in just a moment, but I just want to get a feeling from your side, somebody who works in that market, and then from Stephen, somebody who's got a very good knowledge of the market as well. If you were now 22 years old, so that's what, 4 years younger than you are at the moment. If you were 22 years old right now, what would you be looking at? What's the first thing you'd be looking at in a first home?
If I were 22 years old, I would probably look for something that was fairly close to where I worked, where maintenance was low, so perhaps a sectional title apartment or a small cottage, and somewhere that something that I could afford to take the lowest mortgage possible. So I would like to have at least 20% cash deposit, and I would look for something that was extremely saleable, that was secure, and that had parking. That when I could afford something bigger and better, I could sell it easily. But it would definitely relate to where I worked and convenience.
Okay, fine. Let's take that as the first answer.
And of course, affordability is very important.
Right, yeah. Which it would have to be if you wanted to put down that 20% deposit. You, Stephen?
Yes, I think it covers a similar type of thing. So, you know, if we think about debates of location, it's not so straightforward. You generally find people are balancing a whole bunch of things. So some people will take the, you know, living closer to work. Some people will take the particular option of living closer to where the family is and friends and might still commute. So you do find a bit of disparity. In the entry in the market, what you generally tend to find is that the newer developments are slightly outside of, you know, or they're sort of closer to the urban edges. So what you would find is that generally that's where the guys are finding the better value of stuff that's probably sort of slightly more modern, has recently been sort of built, and, you know, gives them what they, you know, they want. Whereas the established sort of older suburbs, there's perhaps limited, you know, opportunity. So I do think it's extremely personal, and people have got to understand where it would. So is it the 5 minutes to the office, or, you know, during the week, or is it, you know, rather the 5 minutes to the family and friends over the sort of weekend is probably the bigger thing. But I don't think we can underemphasize at the moment that affordability, especially in a low interest rate environment where we are today. There's probably, on a long run, this, you know, mortgage installments will only increase from where we are today, because we don't think there's a substantial downside to where the interest rates are. Okay, when we come back after the break, I want to start digging down into this, because this whole affordability thing, I don't know how many times on this show, and on nearly every other show on CNBC that I watch, this instant gratification thing comes up over and over and over again, and I just want to find out if that is also part of a possible future problem in the property market. We'll be back in just a moment.